Hey, good morning, everyone. Welcome to another episode of Breakfast Trades with me, Nebraskan Gooner from Elevate Trading, elevate-trading.com if you would like more daily updates and educational tips and tricks from me. But today's video, we're going to talk about EMAs, all right, exponential moving averages. They can be very useful to trading if you know how to use them. And in this video, I'm going to show you exactly how I use them, how I upped my trading game by using them, and also one very, very important thing you really need to understand about EMAs. Let's get to it. Check it out, you guys. So we've got Gooner EMAs pulled up here, which is going to be the 11 and the 22 EMA, as you can see here. All right, the 11 EMA is green, 22 is red. This is a free public script you can use if you would like, called Gooner EMA. I use it on all of my charts. And then this is also an SMA that I use. And I'm actually going to use this real quick to explain how EMAs work. So you can see here that if I make this a 1 length, it is going to follow price action exactly. Right? Why does it do that? Because EMAs, SMAs are a calculation of the previous amount of candles that you tell them to calculate. So I just did a calculation of 1. All right, so you're going to notice here, if I turn this to 15, that it is going to move much slower now and not exactly with price, and it's going to kind of lag, if you want to call it that. That is because it is calculating the average price of the last 15 candles now as it moves. So the higher this value, the more it's going to lag with price. All right, you can see the 50, it starts to lag even more. 100 is going to drag it down even more. We're going to go to 200, and you're going to see how long it takes for this to catch up with price. Now, I mentioned earlier the most important thing you need to know about EMAs when using them is that they are kinetic supports and resistances. What does that mean? If you just look at this chart and identify a support right here on price, that is never going to move. These candles are set in stone. They're never moving. But if I identify a support here as this EMA, if price does not fall straight down to that EMA, then you're going to see EMA start to climb up here and get closer to price as it calculates the average of the previous 100 candles. So what you need to understand is that if your target to buy at would be this EMA, your target is going to be ever changing. The higher it goes, the higher it goes. So if you were looking to buy over in this area at this EMA, well, you're going to see that the price was only 3,200 there. But then if you wait another couple weeks or months, now it's at 3,600. And you wait another couple weeks or months, and now it's at 3,900. And now it's finally touches the EMA at $4,000, and you would never get your original area of $3,200 because it's kinetic. So you can use these as supports and resistances on multiple time frames for trading purposes, and I often do use them for that. Also, you can use them for bullish and bearish crosses, and some people have built strategies off that as well. Seeing here as we have a bearish cross and price goes down, here we have a bullish cross and price goes up. Many people will also use EMAs for high time frame holding purposes, and they want to see, price above the 200 EMA on a high time frame. Otherwise, they may consider cutting their positions. Feel free to play around with it, you guys. Different EMAs that you feel comfortable with that affect your trading strategy. I like to use a little bit lower values because I'm more of a short-term trader, so I like more quick reactive indicators, whereas somebody who is a hodler or a swing trader might like a little bit of the higher valued EMAs like the 50 EMA or the 99, things like that. So one of the most important things to understand, you guys, to reiterate my point, is that these are kinetic supports and resistances. So if you were in a long from down here on a position and you were targeting the EMA up here, the orange one, you would see that it's going to be ever changing. So if my target started out as 35,700 and we push up here and we don't quite reach it and we bounce again, and now my target is going to come down to 35,100 where it was previously 35,700, because this is averaging the price and it's going to be moving down the longer we consolidate here and the more time we spend not going up. So the longer you see price consolidate at any time, if price is consolidating here for a long time, you're going to see this EMAs come down you're going to see these EMAs start to come down and meet up with price. And I actually have a pretty good example of that on a Matic chart real quick that I will show you. So you can see here, if you were expecting a pullback here and you were wanting to buy at the 11 EMA after this impulse up, you would have actually had to wait, and your target would have gone from 23 cents all the way up to this touch here at 27.5 cents. Had we dropped sooner, we would have likely revisited here for the bounce, but instead we kept going sideways and consolidating until price finally ran into these EMAs, and you can see how that pushed us up and how we tapped it here again, and now we're retesting it again. Really hope you guys liked that video. If you did, please smash the thumbs up. Please subscribe to my content and turn alerts on. New breakfast trades are out every Tuesday morning, 8 a.m. Central Time. See you next time.